G'day, Jerry. G'day, everyone. Jerry, look, I've got a recording happening. I didn't get your intro, but I've just got a recording going. So if you're having trouble getting a recording up, don't worry. I've got one happening. So hopefully that's our fallback strategy. But look, on the things we've talked about, what you were talking about before, the system diversification that I use is based around two core principles. One is that I use a core base of systems which are breakout. And the reason I insist that all of my, whenever I'm trading a market, I must have a core representation of breakout systems is because I want to avoid this possibility of the type 2 error. In other words, breakout systems are the best method to ensure that you never miss the outlier. But then what I'll do, once I have that core representation of breakout systems, and, I might, of say 8 models I trade, let's say, 3 or 4 of them will be breakout. So the types of breakout might be different. So I'll be using a Donchian breakout strategy, the classic sort of turtle trader breakout strategy. I'll use something like a congestion box, a Davis box breakout strategy, which is a form of breaking out from a period of congestion. I'll be using a Bollinger Band breakout method, and various other breakouts. So they're the core representation. But then what I'll do is I will supplement those core systems with what I call supplementary trend following models. Things such as a Bollinger Band retracement entry into a trend, things such as a moving average crossover method, things such as a breakout from a standard deviation channel. I'll be using those alternative supplementary methods to give me more diversification into a single market. Now, the reason I do apply all of these different methods of trend following in a particular market, and look, what I need to say is that every single one of those 8 systems have the core rules of the golden rules of trend following embedded in them. Things such as they must have no profit target. They must have a single entry. They must have a single trailing stop. Each are configured uniquely though, but the actual system itself gives me a diversification of entry into these outliers. And the reason that, so what I find with this broad, diverse collection of different systems to apply to a single market, all trend following in nature, what I find is that when I talk about trajectories, what I mean is this. So each system basically is configured uniquely, and the system constraints, such as where the entry is, where the initial stop is, where the trailing stop is, how that's placed, that defines what I refer to as a possible trajectory of a trend. Now, each of those different systems give me different methods of attacking an outlier, so that when I get an outlier arising, which can be any possible form of outlier, they can be very various in how we define what an outlier is. That the key thing is, of course, their magnitude of directional volatility, but their form, their visual form is various. So all of these different possible system configurations are designed to target different aspects of a possible outlier. So it gives me really loose pants being able to attack a single outlier with a variety of different systems. Some of them stay in that outlier for a very long period of time. Some of them are snagged out because of their system constraints, which get them snagged out. But by applying an ensemble of strategies to that outlier, I find that the outlier itself can be very various in form, but can last over a period of 2 to 3 years, for instance. And some of those models will stay in the whole time. Some of them might stay in a short time, etc. So that's the key to me, to squeeze as much juice out of that outlier as I possibly can with this sort of array of different trend following model.
Yeah, I feel like I get something similar to with the different breakouts. I mean, one of the things that makes the breakouts very loose pantsy is they don't move up like a moving average crossover might continue to move up. As new highs are made, you get almost every day, you get a locking in more profit. And so it's very stair step approach with the breakouts. And if you look at that chart I posted on Twitter of Nat Gas, I mean, that's like the worst chart ever. Big profit, total collapse, right back to the highs. The breakout is so suited for that. And it's kind of perverse in the sense that it doesn't move up quickly. It's stair step. You can make new highs every day of the week and your breakout exit doesn't change. It's kind of a really perverse thing. You're just like never locking in these profits as quick as some of the other more moving average like methods. So it's really giving you the opportunity, you know, to hang on to those profitable trades, which is not what's really on your mind at the time. You'd like to sort of like not give back a lot of that profit in those open trades. But I kind of think I'm getting something similar. And, the performance is dominated by these long-term trends. So, it's just basically how you're going to handle those and how the systems handle those. And do you basically don't get out too quickly, or all your systems don't get out too quickly? So I think I like the breakouts for some reason. That I will admit that that's the one area. Well, it's at least one of my areas where I am a victim of my training, my past. Although I could definitely possibly change if I researched something and found something that had those similar qualities and characteristics.
Yeah, one of the very interesting things in relation to system diversification is this. So imagine you only had one particular form of trading system to apply for your diversified portfolio. So when you apply that single system to a single market, it produces an equity curve or a return stream. Now, what you find with a single system is if you have a single system applied to a diversified portfolio, you will find that the individual return streams of every market in that portfolio are going to be fairly highly correlated because of the nature of that single system. So you'll find that you won't be able to diversify as much with a single system across markets as when you apply an ensemble of different systems to a single market. And what happens is, with those different systems applied to a single market, it actually, at the portfolio level, reduces the correlation of these individual return streams of a market produced from that ensemble of systems. So you can actually diversify wider across your markets. So it's a means, system diversification is a means to actually reduce the inherent levels of correlation that exist in a single market by virtue of the ensemble of different systems you apply. I hope that makes sense.
Yeah, but I mean, every system that's long in a big trend, which the golden rules would say they should be, they must be, their correlation, we're very glad that the correlation is the same. They're all going up for months and months at a time. So it's really the big payoff is the P&L when the market turns around. The short terms get out quicker than the longer terms, and then sometimes that works, and then sometimes it goes back to new highs, and you have to get back in the shorter term systems. So if you're going to apply these golden rules of being in the big trends to all your systems, they're going to thankfully be correlated when it matters.
Yes, I just want to stress this though. So when you the benefits of the correlation I'm talking about is not the benefits of when you are attacking the outliers. They're the benefit of the noise that's produced in that return stream. So in other words, in a single strategy or a single system that is applied to a single market, you might find 95% of your trades are not producing the profit. They're the noise associated with that return stream. 5% might be targeting the outliers. So it's the 95% when you're trading an ensemble of different systems for that outlier. It's the benefits you get from the offsets with that 95% to reduce the impact of that noise. So it's actually not related to the outliers. The reason the ensemble is being applied is because of the offsets created by the noise.
Hey, Rich. Hey, everyone. Is it correct to say that these systems, they're not there to help you hit the outlier? They're just there to help you stay alive. Is it correct to say?
Yes, that's exactly right, Bruno. So there you're basically your method of reducing the impact of a possible string of losses. It's the way to basically reduce the noise of your return stream so that the outlier in that return stream crystallizes out, because every one of those systems will be catching that outlier in various shapes and forms, different aspects of it. So they'll all be positively correlated during the outlier itself. And so they amplify the signal. But what happens is all of the 95% of other times when they're producing noise, they produce these correlation offsets. So that when you're applying this ensemble, it's basically a method of distilling the signal in your portfolio distribution of trade returns.
But how do they do that, Rich? How do they do that, Rich? I mean, if we're looking at the same trend, I mean, how different? I mean, I'm kind of taking Jerry's side aside a little bit, even though I do agree with you that system diversification is interesting, but I'm also a little bit sort of questioning. I mean, how different can they really be if they're pursuing the same trends and the same kind of range trading periods?
They're different in a big way, Niels. It's what it is. It's this principle has come from sound engineering. So let's imagine that our return stream for a single market is broken up into two components: that which we call random in nature and that which we call signal. So in our equity curve, when we get these big step ups, that's a signal. That's a beneficial move in our equity curve. But when we get the drawdowns, or we get the stagnation, that is a sign of effectively randomness, linear signals, losses, wins, etc., small in nature, that is effectively a random perturbation. So because of their random nature, when you start superimposing additional random return streams in association with that randomness, this is the offset you get in sound engineering when you put on your headphones and you get a better signal when you use these signal amplification methods. It's a means that the perturbations, which are effectively random, ups, downs, etc., they're not really related to the signal. That's just the luck of the game when we're trading. Any particular trade entry, if, for instance, the market is efficient over that particular point in time and it's random, we could win, we could lose, but they're random in nature. The outliers are a serially correlated signal, which is different to the random results. So when you apply multiple different systems, return streams together, you get this beautiful, it's exactly the principle of diversification, but you get to this beautiful principle of correlation offsets reducing the noise and amplifications of the signal increasing the benefits of the outlier. So when you look at the relative performance of your equity curve, you get a far better frequency distribution of outliers in your portfolio trade distribution of returns.
Okay, fair enough. But I'm just the one thing that concerns me a little bit is this thing about that we can offset all the bad stuff, but we still get all the good stuff. So sometimes
we do that in a portfolio, Neil. So even not talking about systems, how is it that we get a better risk-adjusted return when we diversify our portfolios? The actual physical mechanism that's being applied is what I'm talking about. It's the ability of return streams to provide correlation benefits to other return streams, these offsets. So that's exactly what I'm talking about at the system level. They produce these correlation offsets with the random signal in your equity curve.
If I'm right in this interpretation of what you're saying, Rich, let's compare two portfolios. One where we have one system, and another where we have a range of systems. When the trend signal is strong, the portfolio one that has one system will benefit the most it can, because the trend will be strong, it will be full positioned, and it will exploit this trend all the way to the end. The portfolio number two will have a range of systems, but all of them individually will capture this strong trend and benefit individually the best too. But as you have a lot of systems there inside, the return of each system will be small. But because you have a range of them, the return of a portfolio will be supposedly as good as the portfolio A that has one system. Now, when the trend signal is weak, or let's say the trend itself is weak, it's choppy, it's not very strong, it doesn't produce a real outlier, portfolio A will suffer because it will get in, get out, get all that whipsaw we wish we could avoid. Now, systems, they will not agree with themselves, let's say. Some of the systems will be on, some will be off, some will be long, some will be short. Now, the performance of each system will, in a way, offset themselves. So instead of having an array of losses that portfolio A would have, because it gets in and out at bad prices, portfolio B will be fine, because the correlation of the return streams of each system will offset themselves. Is this a correct interpretation? And sorry if I've rambled too much. I tried to make it.
No, that's a correct interpretation, but I'll give you a visual method that's easier to understand. And you can also go to your Excel spreadsheets and try this out, and you'll see how it works. So let's imagine we've got a return stream A from system A, which has the following sequence of returns: -1, 0, 0, -1, +1, -1, +1, +15, -2, -1, 0, 1. That's one return stream. Now, the +15 there was the anomaly. That's the outlier component of that. The rest can be regarded as effectively random outcomes. Now, let's get another return stream with the following scenario. This is for another system: -1, +1, 0, 2, 1, 0, -1, +12, -1, 0, 1. That is another outcome from a different system that still catches that signal. That's where you got the +12. The rest is effectively random outcomes. So what you find when you get 2, 3, 4, 5, as you start building it up, when you superimpose them all together and you get a sum total of the additions at the end, which is your market return for that, correlated on, well, that ensemble of systems, you'll find that the offsets of the ones, the zeros, the twos, the +1s, the zeros, they offset each other, and they don't perfectly offset each other, but relative to the outlier, every single outlier in that series gets amplified because it's plus in sign. So you get +12, +15, +17, +14, +10, +8. They're all of the points of that trend following system that catch that outlier, but the rest is just a random outcome from losses, whipsaws, And what happens, they get offset to the extent that your relative proportion of the signal of the outlier to that total return stream is significantly enhanced. So the assumptions in what I'm talking about is simply that I'm assuming that it is a signal of the outlier which is positive in sign and is amplified through addition, as opposed to the other trades that are in our portfolio distribution of returns, which are effectively random outcomes. So that's what I'm saying, and why they're linear in nature. And so, because when you trade any system, it's not automatic losses. If you're trading a random system, you're going to have random wins, random losses. The important thing is the signal is the thing that gives you that amplification.
Rich, obviously, I'm sure you'll understand if I couldn't quite follow all your pluses, minuses, and all of that. But my question is, when you think about this, the plus 12 day, the plus 15 day, the plus 17 day, isn't that, or aren't they likely to actually happen on the same day if it's the same trend?
Okay. It's the same trend. So they're all going to amplify for that day. They're all going to be pluses. But the rest of the days, which we don't have that signal or that outlier signal, they're going to be effectively random outcomes that get offset.
Well, okay, so let me just ask you about that. So let's just imagine very simply that what you're describing are 5 different systems that are along the S&P, and one day out of 20, let's just say the S&P has a huge up move, and they all the systems catches that with slightly different amplitude. Is that fair to
keep going. Okay, that's good.
Okay, fine. That means they're all long. So my question is, how can all the other days be different if they're all long and it's the same market?
Because, Niels, we don't get 100% efficiency in the signals we target with our system. In fact, any trend following system, we often talk in terms of it has a 30% win rate. That means that 70% of the time it's losing. That loss was because they weren't attacking trends. So we can't have a 100% efficient, perfectly efficient system. So what they were attacking was either a segment of a mean reverting pattern, a random outcome. They weren't attacking an outlier. When we get these wins, that's from a positive result associated with capturing that signal that's in the market data.
If I'm getting this right, it's basically what you achieve when you have breakout systems with different look-back periods. The longer look-back can be still long, while the shorter look-back will already be short.
Right.
But if I'm getting this right, Richard does it in a more, I wouldn't say precise way, but in a better way that
no, I do it sort of more in sound engineering terms, Bruno. I'm just applying principles of sound engineering to my equity curve. So it's, what component of that equity curve is the random component? What component of that equity curve is the correlated component that relates to targeting the outliers? And when you superimpose return streams together, you effectively, that's where you go to the wave tank in the physics class, where you know about the destructive interference of waves and the amplification of waves when you get things in sync together. So it's just applying those principles, and really that lies at the heart of the portfolio diversification. That is the physics behind why you get superior risk-adjusted returns when you trade a diversified portfolio. In economics terms, they don't get to the wave tanks in the bathtub, but that is the physics principle operating behind that.
Richard, so Trendviso here. I had also done a significant amount of assessment and studies, and I found that the supplementation which you described can be further sophisticated.
Hey, Rich, and I have a question here.
Bruno, can you hear us?
Perhaps you've mentioned in the podcast, but I'd like to make it
Bruno, I was just hearing someone speaking. Could you hear him?
No.
Can you hear me now?
No, Bruno. I'm asking a question.
Oh, sorry. Well, go on if there's someone else.
Yeah. Anyways, Richard, in order to supplement in the supplementation that you described, in addition to price-related dynamics, and when I brought in certain physics principles, especially the sound engineering ones, what I found was alternative data was extremely valuable as well. Have you tried using alternative data in any of your analysis or systems or ensemble of systems? I could highlight it with one example, which I posted in the tweet nest here with the example of Peloton close to its earnings somewhere in November, where I was able to use the trend following within the alternative data from the web dynamics in order to enhance my signal and manage my portfolio risk. And this is just one example, but there have been countless examples, especially within equities, not necessarily outside. And for other products such as nat gas or a few other things, some other alternative data sources and their trends to be added to the ensemble of systems. Have you tried doing that?
Look, I have tried with synthetic data that I'll embed serial correlation into that data. But look, I haven't probably got to the same level as you. You sound as though you've got your head right into it. But look, I'm just a bit sort of amazed at the moment, because I thought everyone accepted these principles, and I'm having a hard time coming to grips with it. But I'm wondering, do people on this forum here, do they believe in this principle of wave tank interference?
I can certainly see, and we've spoken about this many times, I do see the value of different styles of trend following, right? That there's no one right. And so if we believe in diversification, we should also believe in the fact that if we apply sound trend following systems or methodologies, that is a good thing. So I don't disagree with any
No,
of that.
all I'd be saying, Niels,
Yeah.
is that, okay, I'll ask you, what do you think are the actual mechanisms behind what improves the risk-adjusted return when you have a diversified portfolio? What do you say?
So okay, so let me just stick with my train of thought. Maybe it comes out like that, but I can see the idea of having different ways of getting in. You know, whether it's a moving average crossover, I don't use that, but I mean, if it was and a breakout and something else, I could completely get that. Um, but I also get what Jerry's arguing, and that is that maybe we can get all of that, or maybe we can even get something that's better. I don't know, but just having sort of one core philosophy, because we know the philosophy works. That's always the starting point, right? And then we apply different time frames, and we apply it across different markets, etc., etc. So I guess from where I'm coming from is that I don't think there's no wrong or right. I don't think we can say with with a kind of firm voice that yeah, you definitely need to do it this way, because I always come back to the point that as long as we apply the sound methodology of trend following, we're in good shape. And I think Jerry and I talked about this on the last recording we did, where it's very hard to screw up trend following if you just keep the core principles right. Um, Even though there are some things you can do to do that, but let's just stay with it. So all I'm saying is, I think you're right. I think Jerry is right. I think we're probably all right. The question is just the level of complexity we want to employ in our systems. But I don't
Yeah,
think
look,
we can
I
necessarily.
didn't want to make it. I didn't want to make it complex, Niels. I was just
Right.
thought that people's brains were all thinking in a similar way. So, from how I understand Jerry's system with his four systems, the benefits that I'm talking about are exactly the benefits he's achieving with his four systems. It's the same benefits I'm getting with my 8 systems. I might choose to use different models, but recognizing that the majority of them need to be breakout to avoid the type 2 error. So the balance are basically ways to just supplement my returns or increase the signal strength of my outliers. So, I think we're all talking the same thing. I'm just using a physics example to explain how the principles work, as opposed to a risk metric view or a statistical way of working out how it works. So I was just looking at the underlying mechanism. So, yeah.
Niels, did your system pre-done that you discussed back in January of 2021, I think it was, it kind of straddled both worlds did it not? And did you see something similar to what Richard's describing, or was it more what we see with our traditional, knuckle dragging trend following that we all love?
Sure. So the way we attack the problem, I think, is somewhat similar to what Richard is describing, right? Back then, and this is kind of 2006, 2007, we were saying to ourselves, okay, if we were, inside a bank and we wanted to put together a trading desk of different traders, but obviously they had to be systematic, and therefore, in our case, they would have to be models. What what are the things we would look for? So we put together this group of different types of systems. So one group of systems, still trend following, but we would classify them as someone that were mimicking what discretionary traders might do. So what might a discretionary trader do? They might be a little bit slow to get in because they were looking for a lot of confirmation, but they might be quite quick to get out because they would get scared quickly. I mean, I'm not saying that it's right, but this is, I think, how we thought about it back then. Then we had a group of people who were just the very classical trend following, right? Nothing too fancy, very robust. And then we had this third group, which we call kind of the plunge protection team. So something that could react really quickly, and it was only there to really help out if there was a crisis, because we felt that that would always show up in bonds and equities. So they didn't even trade the full portfolio of markets, right? So it was just a way to think about how could we get something that was different. But I can't say that it's better, right? And of course, because at the end of the day, I think what's more important in terms of what drives the performance of that strategy, which obviously we publish on the website every month, it's probably more time frame. That particular strategy does not have as loose pants as Jerry or Richard, so performance is different. There will be years where it's doing well, and the loose pants are not doing so well, and vice versa, right? And of course, also the other thing about which markets it trades. So I guess what I'm coming to is kind of what Jerry's saying, and I think Richard agrees in a sense, and that is, in the very long run, it probably does not make a huge difference. It can in the short term, but as long as we stick with the core principles of trend following, whether we use one method or another method, it's probably not going to make a huge difference. So even though I think from my perspective that the systems we built, super easy to run, takes 15 minutes, it's all automated every day, right? But that's exactly the same probably with Jerry systems or any breakout system where you just have different time frames. It's not different in that respect. We just thought about it differently, because here comes another thing, Brian, and that is, when you want to break in. So back then we were trying to build a business, right? So how much attention could we attract by just doing what Jerry is doing? Probably not much, because they would rather want Jerry to do it for them because he's the expert in that type of system. So if you had to, do something to attract attention of investors, you would have to think about the problem differently. And that's what we did. And that's why we structured it in this way. But then I look at what we do at Don, where we run two different types of trend following. And I certainly can't say that what we developed back then is better than what Don is doing. Probably not. I mean, so, yeah.
I would say this. I would say that there are two ways to increase the relative proportion of outliers in your portfolio returns. The first way is the longer term look back. And what the longer term look back is actually doing is it's reducing the noise in your trade distribution of returns. Now, what I mean by this is that when I've done my analysis on short-term to medium-term to long-term systems, I'm finding that they are all catching the outlier, but we've got to recognise that our system results are a combination of our losses and our wins. And what you find is that the short-term systems have very many more trades because they're short-term, and most of those trades are losses. So when you compare the relative frequency of the outlier in your short-term system, your medium-term system, and your long-term system, you see that the relative frequency of that outlier increases as you go for the longer lookbacks. That's one way of increasing the relative proportion of outliers in your distribution. Another way, well, there's actually three ways. Another way is to diversify across many more markets, because your relative frequency of outliers in your distribution of trade returns, provided you're not only diversifying across markets, you're also being more selective in the trends that you want to participate in. That also increases your relative proportion of outliers in your portfolio distribution in our hunt for outliers. The third way is through system diversification, because of system diversification, each one of those systems, which is medium to long-term look back, so each of those systems is not a short-term look back, it's a medium-term look back, but the nature of the trajectories that those systems catch, when those systems activate on an outlier, you get maybe 4 times as many systems trading that single outlier as you do if you are less diversified in your systems. So what that does, because those results are on the outlier and the magnitude of those outliers is quite high, relative proportion of outliers in your signal increase through that method. So there are these 3 methods you can do in our hunt for outliers to improve or distill the signal of the outlier in our portfolio trade return.
That's all good. I've been taking notes, and so I'm going to go through a few of my notes here and make some comments. Okay, so back to this one question of how do you improve risk-adjusted returns? I would have said markets, obviously. That's what I do. And I do think that the systems are the different entry and exit points. I mean, I've been doing that my whole career, so I'm definitely a fan of it. I guess in some respects, I pick and choose the things that I think are more incredibly important or less important. And I always think that trading more systems is important, but it's just so easy to do and so uncontroversial. But I haven't really looked at the research recently, but I would have once again just assumed that the biggest payoff for the systems is not risk-adjusted return, even though we don't really care about that, right? But it's more like I said earlier, it's they're all correlated in this big uptrend that may last for a year or two. But then when the trend reverses, the short-term system, you'll be very happy with it because you get out and you make the most profit in that system. It got in first. The ATR is probably lower. It gets out quicker, so you capture more of the profit. However, if the market elects that system 1 and goes right back to the highs, then you got to get in again. System 2, 3, and 4 end up maybe making more because they never got out. So that sort of diversification of P&L, I sort of call something different. That's a separate category from risk-adjusted or diversification that you're going to get from the markets. And I think that I'm not a fan of, Niels and I we go back and forth on this, but I'm not a fan of there's no one right way. There's no one right system. But I'm trying to figure out a better way to articulate what I am for. And I think that rather than saying there's no one right way, I would say that there are a lot of ways that are similar. And as I've said, all 4 of my systems, they make the same amount of money. So I would just say none of those are better than the other. Some of those are going to be way better on the current trades. I mean, they're going to be so much better, and some are going to be so much worse, or they could all be about the same. But there is one thing that I would say is that if you go too short term, it's going to be no good. So there is maybe no one right way, but there's many bad ways. And something too short term, the 50-day breakouts, way too short term. I don't even know if it makes money any longer. And maybe it's even possible to get too long term. The 500-day breakout, that seems unnecessary and probably a little random. The sample size is pretty low. So I do think I got a lot more to say, but I'll hold it for a while.
Yeah, no, so let me just comment on that, Jerry, because I completely agree with you. So when I say there's no one right, what I mean by it, once you've established your portfolio of markets, right, and once you've established that you want to trade long term, because we know that from the evidence that short term trend following is not nearly as profitable as long term trend following. What I mean is that whether you use Donchian, so price breakout, volatility breakout, maybe even a moving average, maybe some of these other methodologies, I don't think that there is one that necessarily is better. So I agree with you. We get back to this semantics about similarity, right? But let me just throw in another spanner to all of this, and that is we did a recent podcast episode with Dr. Ben Hunt on narratives, and it may seem a little bit unrelated, but I think it is a little bit related. And he talks about at the moment how Bitcoin has become Bitcoin, right? So meaning that Bitcoin is trying to become mainstream, and in doing so, it's probably destroying itself. And I just use Bitcoin as a proxy for crypto, right? So the more mainstream they want to become, the more accepted they want to be, they're probably destroying the good things that they started out with, so to speak. And I was thinking the other day that maybe we, as trend followers, are maybe doing the same. Meaning, we think about, and you and I talked about this, Jerry, about how can we create more consistency in our returns, even though it might actually be something that we do by sticking to what trend following is all about. So I'm not saying this is necessarily a good example of that, but I do think maybe that we're trying to have higher risk-adjusted returns, et cetera, et cetera, et cetera. And I wonder if in the pursuit of doing that, we're also trying to make trend following, so that everybody likes it, but actually in doing so, we're taking away the really good stuff, and we shouldn't try to become mainstream and get accepted by all of these allocators, pension funds, etc. We should really just stick to us being the little nerdy group in the peripheral, and not think so much about how big or how popular we become, if we wanted to preserve what's really valuable about what we do in the long run.
I agree with both of you. I think that first of all, we must follow our trend following principles and our rules that based on our principles. And if we do something else, and some guys do something else, and they call it trend following, for example, like Neil said that some CTAs they trade without a diversification, or maybe somebody trade in a too short term and calls it a trend following, but it's not trend following in classical way, it's momentum. So a lot of these things, but I think we can have different approaches, and these different approaches will be very similar, and maybe it will be a very similar result in a long run, or maybe not very long run, or even in 3-4 years result. I think so. But if it's classical way, it's the right way. But if somebody calls a trend following something that is not trend following in a classical way, I think it's for me personally, it's a big mistake, and it leads to misunderstanding, and it's of course it's not the right way for me personally.
Hi guys, can I ask you something? By the way, this is a great meeting, very, very interesting. Can I ask you about the short-term trading systems, and why do you think they don't work? But not because of a back test, but just out of the box, in an out of the box kind of way. Why do you think they don't work? And do you think they never worked, or they stopped working, and for what reason? But because they have something that's good, that it's that they cut the give backs of the trades. And from what I understand, Richard, you said that the bad thing is that the signal to ratio is much smaller. But thinking out of the box, why do you think they don't work or they stop working?
I personally think it goes back to Perry Kaufman's view of the nature of markets as they mature. So, back in the 1970s, 80s, where the markets were less mature, I think that there was a far higher signal to noise ratio in those markets, so that you could actually use short-term trend following systems to capture a vast proponent of that signal. Now, obviously, ideally, everyone wants a short-term model if they're trading a trend, but the reality is the level of noise in the market has significantly increased from those days. So the level of noise, so if you view it from, Jean-Philippe Bouchard's viewpoint, it's the participant mix that changes the nature of the trend over time. So the impact of different forms of behavioral traders, like those that trade mean reversion, those that trade HFT, all of this myriad of different forms that slowly enter the marketplace over the course of time as a market matures, actually varies that signal and creates a lot more noise in that signal. So, if you're viewing the market as having, two broad forces at play, a convergent force or a mean reverting force and a trend following or a divergent force working, when you get different representations of participant mix in that sort of spectrum of behavioral types, you get far more noise in the market than what was experienced in the early days. So, I think Perry's right in that as markets mature, they become, the nature of the trend becomes a lot more volatile, a lot more messy. So you've got to adapt your techniques to have even further loose pants, step out to medium to long-term timeframes to sort of capture those signals. So if you'd used your medium long-term signals back in the early days, yes, you would have done really well, but you wouldn't have known that at the time because you were trading those short-term signals and doing really well. But you will find that the medium to long-term probably worked over the entire period. But what hasn't worked is the short-term models, which have slowly been vanquished by the level of noise in the market over time.
And
if I could just add to that, the long-term systems worked in the 70s and 80s as well. So when in the late 90s, when we started noticing the choppiness and we kept getting bounced out of trends and having to get back in again all the time, we started researching longer-term lookbacks, and they worked as well or better during that 70s and 80s period. And then one thing I would just bring up, which I learned from Richard, is that historically, I had a different opinion of what was causing these problems, this choppiness in the trends. And even this week, Mike Harris was tweeting, and I was hoping Richard would hop in and bail me out against Mike Harris, but he was sort of tweeting the same thing that I used to believe, which is too many trend followers. There's just too many trend followers, and this is the demise. But I'm more of in Rich's camp now, which is it's the opposite. There's too many convergent traders who are doing counter trend trades against the major trend that is selling off, getting short or selling during our uptrends that would come down and hit the 50-day low, for instance, and get us out, only to return right back to the highs. So it's not too many trend followers, it's too many counter trend traders, the convergent traders who sort of forced us over time to have the longer look back so we don't get bounced out of the trends. Yeah, what do you think, Rich?
I wish I could have helped you out, Jerry, but unfortunately Mike Harris has blocked me, and he's blocked me for many years now because originally when I was having a chat with Mike Harris, I made the fatal flaw of saying trend followers don't predict. And for that, I got the famous block, and I've never been able to participate in his discussion since.
Good job out of you, man. You're doing good.
Hey, everybody. I wanted to just speak to Rich's point about system diversification real quick. I think I have an easy understanding for it. Say you have two systems that are both targeting about the same look back, meaning your average hold is going to be about the same amount of days. For any given trade, one system is going to handle it a little bit better. For a outlier, it might get in a little earlier, it might stay in a little longer. And for a losing trade, it might get in a little later and get out a little earlier. So if both those two systems have about the same expectancy, if you trade them both together, on average, you're going to do a little bit better. So unless your system happens to be the one that picks the best entry and the best exit every time, adding other trend following systems, as long as it doesn't increase costs more than the added benefit, it's worth doing.
Spot on, Seth.
Yeah, I agree totally. I mean, it's just a no-brainer. It's do it, And I left off one of the negatives of the breakouts is they probably more so than any other approach, the breakouts can have a tendency to buy. Different lookbacks can have the tendency to buy and sell on the same day. So that's kind of a bummer. I've tried to add a feature to the breakouts that attempt in a natural, uncontrolled way to space out the trades, but it doesn't always work. And then the problem with, as Rich said, there's nothing more important than you can't have systems that don't get into the trends. So I don't believe in filtering out trades, but I do like to try to filter or add a little tweak that allows it to naturally space out. If you force it to space out, like the old turtle methodology of we had system 1 and 2, and sometimes 1 and 2 signaled on the same day at the same price, what you would do is insert yourself into this trade in a non-systematic way and make sure that it had a half of an ATR in between the two. That is going to test out to make less money.
So let me just weigh in with a few thoughts on that original question. So I look at it from two ways when I say that I don't think short-term trend following works as well as long-term. One, if you just look at the evidence of the short-term traders index from SocGen and the SocGen trend index, I think you will find that the trend index outperforms the short-term traders index. Secondly, we run an exercise where we take this as part of our kind of internal research, where we just look at the same trend following model, and we go back to year 2000, and then we just look at different time frames. That's the only thing we changed is the time frame, and then we can see for each calendar year which time frame was the absolute best and which is the worst, and everything in between. And of course, you do find that some years a shorter term time frame works. For example, in 2008, the absolute best time frame was 50 days, but all the other time frames worked as well, right? So 200 days also worked. So, but if you look at it over 20 plus years, you find that most of the annual selections as the absolute best time frame is longer term. So that's another reason why I say that generally speaking, I think long-term trend following works better. And then finally, you could say, of course, well, why would short-term trend following have worked better in some years during the last 20 years? Well, my thesis is, of course, that this overall stability we've had in markets where the central banks have been very strong, this whole globalization and what it's led to, in that sense, you could say maybe trends have been a little bit shorter, which is why there has been years where longer term trend following has not worked so well. That's perfectly fine. But I think that's changing. And I think we're more likely to go back to what we saw in the 70s and the 80s and the 90s going forward. But even during a period of time where central banks were, pretty good at keeping everything, quote unquote, stable, long-term trend following still performed better over a long period of time. So that would be my reason why I said that remark as I did.
I think that it's very interesting and very important information because a lot of young traders, maybe even all young traders that I know, and me included in the past, all wanted to be short term because it looks more attractive for investors. It looks more consistent, and so on and so forth. And it's very important to understand how this works, in fact, how trend following works. And these noisy moments, these noisy factors, is not good for performance, especially for long term performance. So, of course, we can see 1 year or two, as Neil said that, and Jerry said that. We can see 1 year or two with good performance in the short term space, even a better performance, but we see very important to understand that in all the back tests we can do, we see the consistency, the same performance of a long term trading in 70s, and nowadays we see the same. It's very important to understand, and of course, it's very interesting to understand the reason of it. It's interesting, but I think that the evidence is enough, and I don't think that it's very. Of course, I can't. I don't know this exactly, but I don't think that it will be changed. It will be very strange for me personally if a short-term look back started to work on a consistent year-to-year basis better. It will be very, very strange. It will be maybe against the logic of trend following. Maybe I can be wrong here, but I think it will be very strange. So we have this evidence-based investing is very important. Like Niels teach us, Jerry and Niels teach us this.
I just wanted to mention one thing, go back a bit. I really enjoy, and I've enjoyed it since Richard started doing it, is listing off, as an example, listing off, -2, -4, +15, +12. I love that because back in the day, we used to, once a year, we could go up and sit in the big room and sit with Rich and Trader. We could talk to him in the morning and ask questions, and then they would take us to lunch. And so trader for the day or something like that. I forgot what we called it, but it was really fun and a bit intimidating because most of the time we were off in another building on our own. And so I remember one day, Rich pulls out a piece of paper and does that same thing. Like, dude, here's how it works, which I guess I obviously already knew this because of the training course we went through, but just a reminder, it's -2, -3, -5, +12, +20. Back in the day with our systems, a big trend was 20 ATRs. So anyways, this is the point I'm trying to make, is that when Niels and Rich started talking about this 30 minutes ago or whatever, they got into days. No, these are not days. These are trades. Now, the vol targeting crowd, the vol management crowd, it is days. Yes, it's days. They quote returns, days, weeks, months, years, whatever. But for us, this -2, -4, -3, +20, +50, +500 in Tesla, for me, that's me looking at the trade and how much the trade made. And of course, with the classic trend following, this is one of the major complaints is, well, wait a second, there's a lot of information between that entry and then you just quoting how much the trade made plus 50 ATRs. What are you doing with all that information in between where there's this volatility and drawdown, etc.? And my response is nothing.
By the way, this definition of Richard, when he said the description of trend following in only few sentences, +1, -1, -3, +4, and +20, I think it's one of the best descriptions, and I have told it before that for me personally, it's one of the best description because it's it's short and it's very important things only in a few words, and I think because of it, it's a genuine description.
Yeah, and Jerry, you are totally right. It is always in trades. It's not in days. The use of a calendar, a day, a week, a month, or whatever, that's not how we trade. We don't trade a day. We trade a trade. So it is all in trades, and the best way to look at it is from a trade-by-trade example when we're looking at the trade signal. Totally agree with you there. Look, just something to get the mind wrapped around as well is when we start looking at a period of returns of, say, a 6-month period that might comprise, I don't know, 200 trades or something like that, or 100 trades, you get far more dispersion when you're looking at it from a short window than when you start looking at things from a much longer time frame. And you might be familiar with that chart we often see of Twitter, how if you view things from a daily basis, you get this very volatile performance result. But if you look at it from a yearly perspective, it's still volatile, but we start seeing a signal crystallize that says it's got positive expectancy. But when we look at it from the period of decades, we get this magnificent exponential rising curve. So the short-term period is still embedded within that decade's worth of returns. But what is really driving that exponential shape are the outliers. It's the asymmetry that exists between the relationship between those fantastic wins versus all of the rest of the trades that just keep our head above water, those small +1, -1 zeros. All of those small things which have such a big impact when we look at things from a short-term perspective, and gives a huge dispersion of returns of the trend-following managers when we're looking at it from a short-term window. But as we step back out, we start seeing, most of the trend followers are all producing this great exponential rising curve over the decade. So what is doing that? That zoomed out perspective is due to the significance of the outliers that is creating that exponential rising curve. And it's the same reason why when we look at a 5-minute chart or a 1-minute chart, we can see price moving, in a perturbative manner, up and down or whatever. But as we step out to the daily, the hourly, the daily, the weekly, then to the monthly, when we get to the monthly, we can start seeing the nature of the trend that is being driven by these fundamental causative drivers. And this is the whole principle of why we prefer stepping out to the medium and to the long term. It's to reduce the impact of that noise at the short-term level.
And the JPP research that we talked about a few months ago, that also, I think, lent a little bit of encouragement to a longer-term strategy, in the sense that his research said something like these exogenous events, oh no, wait a second, endogenous? Yeah, the endogenous events last a year or two. Is that right? Did I get that right?
Yeah, endogenous are the ones that we're after, Jerry.
But he also said they last a year or two. So I felt like at the time when I first heard that, I have inadvertently stumbled onto a deeper truth, not just what the back test said. It's more like the back test is saying the same things that his research came up with.
Yeah, and what JPB actually said was, with those endogenous events, the difference between an exogenous event, which, say, is a news event, something that people know about and can understand, is that the signal is it is a far shorter duration. These endogenous events are things that arise within the market itself from behavioural influences, from people sort of copying other people's behaviour, fear and greed, all of these things. Because of the uncertainty surrounding the causal drivers of those endogenous events, JPB was saying that's why they're far more enduring, lasting up to 2 to 3 years, of these magnificent trends that it takes a long time for people, using hindsight measures, to work out what is driving that trend. And they're exactly the forms of trend we want to be riding.
And I want to say that I see that some people, and maybe a lot of people, investors especially and young traders, they want to see instant, immediate results, and they like it more than truth. They like it more than logic. They like it more than evidence. And so I think that the traders' way of mindset is to handle all this pressure, handle all these opinions, and so on and so forth, and to follow this, to be disciplined in following rules, and maybe in 3, 4, 5 years. People, investors see, sophisticated investors will see that that person, that trader have good results for maybe 5 years, for example. And that guys that had their results every week or maybe every month and who were very popular have no accounts now. And so if a person, if investors want to have to see immediate results, it's I think it's not a good idea to to listen this to and it will ruin the account together. I think so. Let's ruin an account together with this. Something like that. And I think it's no, not like this. First of all, rules, but not investors. I always say this.
So I did like that idea that Niels brought up earlier about maybe the CTA industry. Obviously, I tweet about this like every day, multiple times, that it's getting away from all the good parts of trend following. And my most recent changed my pinned tweet to a tweet I made concerning an article that was a good article that was put out by Mount Lucas that says with trend following, beta is not just fine, it's preferable. So I like that, and because too much of what the CTA industry is doing isn't, too much of it is taking small profits, not letting profits run, and not being pure trend following, and giving people that beta that they want, which is something much different than buy and hold, and when the stock only buy and hold, and more diversification, more safety, more chance at responsibly making good money. I was watching or listening to a podcast the other day with Meb, and one of his quotes was something like, I just want like trend following beta. It's like, can someone just please give me that? Like, and I think that's so important. And to some degree, I think we can take this lesson from the S&P. That is this simple rules based that everybody wants. That makes about 8% a year and a 50% plus drawdown, and yet people can't get enough of it. Now, parenthetically, of course, we don't want to make 3 basis points in managing people's money, but I think to some degree that's a good model for us, that we with our pure classic trend following, we can create a product that and an alternative for people to invest in that is easily to explain and certainly does better than those numbers that I quoted from the S&P. And here's the kicker. I mean, here's the bummer, and that is the classic with one entry, one exit, and a stop loss. It's better. It's better. So there is no compromise. It will beat everybody else absolutely or risk adjusted if you measure risk the correct way. And it's better and more robust than all the other methods, and you cannot beat it. So that's the kind of crazy thing, is that if you get away from that, it's not going to be nearly as reliable and, have a tendency to make money almost every year.
I liked when Mark Brzezinski said that in one of the episodes of Systematic Investor series, that investors' opinions, changing very fast. And I mean that now they see stocks, and Nils said that stocks, yes, but Nils said that stocks didn't perform in passive stocks for 16 years. from 1958 to 1964, as I remember, 74, as I remember. So, and nobody invested in stocks. So, and also Mark Zybrzynski said that we are trend following strategies can give such benefits that no strategy can give to a people. Trend following strategies perform in crisis environment, and trend following strategies perform in non-crisis environment. And I think it's very important point to understand this. And like Neil said, that we it's not necessary to have a crisis to perform, but in crisis, when SP500 goes to very low, goes to bad performance, trend following perform well and even perform better. So it's very, very important and interesting.
I want to raise something that was interesting today, because I was having a discussion with people on Twitter, and I was saying to them how the index that Niels and I create for our monthly reports, it's called the TTU Trend Following Index, and it's created in a way that's different to how the BTOP 50 or the SG Trend is created. Those indices are equal weighted indices that basically look at the size of the trend following firm, and they take the top 50 or whatever of the biggest trend following firms, or they might take a fixed number of trend following firms that had the best performance results and use them for the weighting of the index. But the way we create the TTU Trend Following Index is actually a method of allocation in itself. And for those people that are interested, if they want to look at, we offer a solution for those investors that have a small amount of money, say $500,000, that want exposure to 5 different trend following funds. We use this method called the Serenity Allocation there, but that can all be read about in the monthly reports. So that's a good method, but perhaps the best method of all. And when you look at the risk-adjusted performance of the TTU Trend Following Index, it is actually the most superior form of allocation itself. So it produces a compound annual growth rate since 2020 since 2000 of 8.77%, with a maximum drawdown of 18%. 18% for the index. Now, this is how we calculate that index. What we do is we say we will only include the trend following firms that have a 15-year track record or more that we can obtain from this Nielsen Hedge CTA data that they provide us. Now, the method of allocation is basically an equal weighted allocation each month based on those funds that have met that criteria that exist in that particular month. And every single month we might, you might find over the course of time some funds drop out, and if they do, they go to zero. But if they stay in, they're included in the results. So it's not a hindsight cherry picking measure, this TTU Trend Following Index, but it just shows you that whilst we can produce a pretty good result with a Serenity allocation, if you wanted the best result, you would invest in all of those. At the moment, there's about 60 trend following firms. If you had the capital, theoretically, you'd invest in all of those trend following firms with an equal allocation to start with. And then each month, you'd just rebalance according to the particular ones performing. But it produces the best result of all allocation methods that I've actually tested out. I thought that was very interesting. It's actually a method of allocation as opposed to an index in the strict sense of the word.
Oh, I love that. I mean, that is so refreshing, because I'm on record as not being in favor of any risk measurements that can be calculated in a spreadsheet, except the long-term performance table, where you take managers who have stayed alive for 10 or 15 years plus. But I think that's pretty darn good. That's my contention. And I think this is what, when you talk about any ratio, Sharpe, MAR, Serenity, whatever it is, you need to say, this is how this spreadsheet calculation transfers into the loss of capital and survivability, then I'll listen. Like, how does this happen? You need to tell me that. You know, my mentors were the smartest people I've ever met in my entire life. And they were very concerned about risk and risk of ruin and staying in the game. It was overwhelmingly about risk. I mean, every day was more about risk. I told you that they sent us a question once and said, fill out, we need an answer to this question. I could not understand the question. It was, would you do this or would you choose to preserve capital? So I knew what the answer was. I didn't understand the question because that was always the answer. But they never mentioned drawdown or sharp, or because, you know, in trend following, the drawdowns are going to come from the big trades, open trades. I mean, you know, if you're doing it correctly, ours didn't do that all the time because we had a very low win rate and we were trading really large. So in the spring of 1984, when we were down, well, I mean, I was down like 35%. Some people were down 50 or 60%. That was all pretty much just obviously losing trades. So taking small losses, I've lived through where that didn't work that well.
I think we must understand the difference between a drawdown and losses. In fact, if a trader loses his money in a discretionary way, I think it's a kind of losses. And a drawdown is a systematic part, necessary part of our trading process, and it's a price we pay for our profit. I think it's like when we go to the coffee shop, to the restaurant, we buy coffee, and we pay the price for it, few dollars maybe. So is drawdown. We pay the price for our success, for our profit, by having a systematic drawdown with a good risk management rules. And it's very good, and we must love all the process and not the parts of the process.
It's interesting, you know, when I look at that TTU trend following index, you start seeing that, you know, because we're investing in 60 trend following firms with a track record of greater than 15 years, you can start seeing those drawdown offsets coming into play when you start assembling more and more of them into a consolidated portfolio. So this 18% drawdown for the index just absolutely blows me away. And this totally disproves this point that everyone says that trend following is volatile. Now, the reality is we get a lot of dispersion in returns in trend following simply because a vast proportion of our trades are basically trading randomness. It's these outliers, this 5% that make all of our glory. So this level of randomness in our distributions, of course, creates this necessary dispersion between every different trend following manager that applies slightly different systems. It's just the nature of the game. It's just how randomness plays. But when you start consolidating all of them into this index, so in other words, if I had a hypothetical, if I was a trillionaire, I'd be allocating into every single one of those 60 trend following funds with a greater than plus 15-year track record. And when you look at the performance of that index, it beats everything. It beats Buffett. It beats everything. Even, dare I say, beats Mulvaney in terms of what it produces. And that's just the power of diversification. And this is what we're saying, is that in our trend following world, diversification is never enough. The more diversification we have, the less dispersion of returns we get in our outcome, and the more that outcome starts actually simulating the outliers that are actually present in that market.
Well, I would also say it's the power of implementing a trend following strategy every day the way it should be. And it's this power of doing this, a system, implementing a system and following the rules. Nothing is going to beat these rules, you know. As long as the rules are pretty good, not too short term, not too long term, but it really just goes to how powerful And almost everyone, by some definition, is going to be more discretionary and less rules-based than the CTAs. And so just implementing a strategy every single day and following those rules, it's really difficult to improve upon that. And who has that track record? Who has a track record approaching that? No one. And that's because none of us have been that great at the first commandment of trend following, which is follow your rules and don't deviate, don't change them too much. Nowadays, one of the biggest problems is so many of the rules that people follow are not robust and have close to no real sample size. They just take comfort in the fact that it's a rule, but not one worth following. So it is just quite amazing. But I think we're all going to commit to do so much better in the future at following our rules. And I know one of the things, I've said this before, but I just can't tell you. I was thinking the other day, since my memory is not that great, how can I remember so much stuff I heard in 1983? I think I've just been repeating it to myself over the years and practicing it. But one of the things that they would always say is that even if you have a bad system or a system that's not so great, I get hit up all the time like, tell me about entries and exits. And listen, I don't think there's anything more important than good entries and exits. I don't discount them. I'm not one of those who say just randomly choose your entry or exit. No. I mean, I want good entries and exits. Okay, I'm sorry, I want the best. But even if you think you don't have the best, and you're going to one of these days improve and get better and learn more, implement what you know now. And especially if it's trend following, of course, and do it consistently every single day. I mean, there's just a tremendous amount of power and so very few people see that in the hedge fund industry. They just don't see that as something to do. The biggest problem that I've faced with that, and it's one of these edges that we have. It's an edge because it's so difficult, which is to sacrifice today's feelings and the possibility of giving back big profits today, this year, this month, for the long term. We don't promise that this trade, you're going to be happy with the way this current trade is being handled, but we do think that if you handled them all like this for the next 20 years, you're going to be very happier than a discretionary or a worse approach that doesn't include good rules.
I think that I'm absolutely sure that these words are great, and not only for all people who want to succeed in something. It's the same role. And also, I want to say that I'm sure that opinion of other people can make us much bigger. It makes us weak when we want to be liked by people too much, as I say always, and not thinking first of all about our rules, our disciplines, our backtests, about the math, the logic behind the system, and all of this. And we see it's a challenge, of course, when we are in profit, when people say how good we are, and when we are in a drawdowns, people say that we don't know how to trade anymore, and don't pay attention on all of this stuff. It's very important for me personally.
Okay, you guys, I'm not getting any DMs for questions. We're in the last 30 minutes here if we go that long. So make sure you raise your hand and ask to be on speaker, or send me some questions, or we're not going to get to something you want to talk about. So another thing that pops up, I don't know if Rich is interested in this old subject, but there was another thing that kind of popped up in your discussion with Niels, and I was just wondering if I heard it correctly. I know that you guys were talking about Jack, and he mentioned some preference for vol management ideas, and you were saying, Rich, that Jack is targeting more of a convergent trades and a convergent approach. And Niels' response was, I don't think he is. And so I got to thinking, like, now how can both these guys be correct? And I think my assumption was that what you were talking about, Rich, is that trend following people who support traders who support trend following and talk about being trend followers, when they add these convergent ideas to their approach, vol management, portfolio management, for instance, they can say all they want to that that's not what they're targeting. Oh no, I'm targeting these outliers. We've had conversations with people and we'll say, like, I'm not cutting my profits short. I'm just taking some off the table. You can word it any way you want to, but the fact of the matter is, if you have these elements in your approach, you are targeting more of a convergent type of trades than you are people who don't have these in. It doesn't matter how you want to describe it or what you say, you are essentially have more convergent ideas, and thus you are essentially targeting more of a convergent environment than the people who are hunting the outliers.
Yeah, Jerry. So the way I view, I sort of tend to like viewing things in terms of a spectrum of trading ideas. So at one extreme of the spectrum, I've got us classic trend followers, the divergent end of that spectrum. And on the other end of that spectrum, I've got the convergent traders, mean reverters, value investors. The vast majority of traders sit on somewhere towards the other side of that spectrum, towards convergence. So with these sort of spectral extremes of divergence and convergence, then there's blends that can occur within those spectral extremes, where I think that we tend to stay on the spectral extreme of divergence. So in the way we talk about trends, you'll see that the classic trend follower is happy to talk about this thing called outliers. But when you hear people like Jack or people that don't necessarily latch on to what we're talking about with outliers, they'll talk about trend. So their discussion, they'll be talking about trend this, trend that. So the extreme members of the spectrum, like the divergent guys or the full convergent guys, they're extremists. But then there are, people that compromise with a bit of convergence in their divergent philosophy, or a bit of divergence in their convergent philosophy. And, you can see this occurring with the nature of the system they trade. So a convergent trader who is extreme probably won't have stops. They're working on this power of mean reversion. The signal that has historically represented itself in the track record says to them that if they wait for a maximum adverse excursion and then counter trend that or fade that move, 9 times out of 10 they're going to be right, because there has been this history of mean reversion that they can clearly see in the historic record. So they won't have stops. But then someone says, all right, but that leaves you a bit, exposed in terms of negative skew. Let's implement stops into our convergence strategy. So in doing that, in implementing those stops, they immediately start shifting a bit towards the divergent style. because their system is being developed or flavored with divergence to sort of stop that extreme risk or that negative skew. In the divergent camp, we of course have these very tight, we're tight relatively. We have loose pants, but our stops, we cut losses short. We follow these rules ardently, which are divergent rules. We are targeting these outliers. But when you start talking about different forms of trend follower who start incorporating things such as volatility management or portfolio scaling, they are starting to implement some convergent rules in their divergent philosophy. They're starting to, for instance, take some profits off the table by reducing their position size, or they're dynamically adjusting their portfolio during the course of a trend to manage risk that way. Now, that is a convergent mindset starting to operate in our trend following space. So that's why I say Jack, in his discussion, he clearly had this almost this convergent brain operating in our divergent space, if that makes sense.
I just want to, I don't always want to find myself trying to defend Jack here, but I just want to ask the question, Rich. And I know there probably is a little bit of a difference, but still, if you have just one system, Duncan price breakout system, the shorter term timeframes of that system, you could argue pretty much the same that you just argued there, because they may get stopped out before the longer term systems, and therefore you could say, well, somehow they took something off the table, but they weren't designed to do that per se. They were just designed to react differently than the longer term system, or at a different time than the longer term system. And so I think there is a little bit of a gray zone where you can't say one is only doing that and another one is only doing that, because I think what Jack was coming at really was just the notion that had been where it sounded like when we were talking about it initially, that you felt that vol targeting would only reduce position size. It would never expand the position size. But what he pointed out was that's not the case, because in the course of a very long trend, the position size also gets increased. So it doesn't mean really, I mean, certainly theoretically, it doesn't mean you're going to make less of less in a long-term trend from a system that never adjusts its position size to a system that may have dynamic position size. You can't say in advance that one is going to make more money than the other, because they at the peak of the trend, okay, the non-dynamic may be ahead P&L wise, but when all the trades are exited, it may be behind, right? But even at the peak of the trend, if the trend has been long and there's been some give back along the way, and a vol or a dynamic system, I don't necessarily want to say vol targeting, but a dynamic position size system could have reduced its position and increased it again. So it may actually have made more money at the peak of the trend. And I think that was the point he wanted to make, that we can't black and white say that one will be, by definition, making more money every time. I think that was his point.
Yeah, but here's where I'd slightly differ in opinion. So I totally understand the adjustment of dynamic position sizing, during different forms of trends might be more profitable than our method. However, what dynamic position sizing actually does do, which isn't present in our method, is it introduces trading costs in addition to what they're seeking. So over the course of a long-term outlier, yes, they might be more successful in sort of shaping their returns with their dynamic position size to take more out of the trend itself, but they're going to be compromising that with the fiddling with their position sizing, adjusting up, adjusting down. Over the course of that 2-year period, they might have many more trades. So what was really interesting to me was this paper by Quantica, which looked at, it was a recent paper that looked at what were the primary factors that were responsible for 100% of the trend following performance. And they identified that there was a factor called trend signal, there was a factor called volatility or dynamic position sizing, and there was a factor called portfolio scaling. And their conclusions were that trend followers on average have about 60% of their effort invested in trend signal, about 20% invested in dynamic position sizing, and the balance of 20% invested in portfolio scaling or reconfiguring their portfolio, reweighting their portfolio. So where I say us classic trend followers differ from that viewpoint is we are 100% invested in our trend signal. So we do have different systems, and our different systems are invested in that outlier at the short, medium, and long-term perspective. That's the trend signal component. These other flavors that we probably we don't participate in to the same degree as the modern trend follower is this dynamic position sizing and this portfolio scaling, but it's through choice that we've decided to do that in relation to the way we view this tampering during the course of the trade, during the course of an outlier, as sort of almost like a predictive response to saying that they understand something about that outlier, so they're prepared to adjust their positions accordingly or adjust their portfolio accordingly. We say, you know, a classic trend follower will say, well, there's nothing we can say about that outlier apart from the fact we follow price, and we're prepared to just stick with that bet that we made originally and just see what it delivers.
Yeah. So let me just leave you with one thing to think about. And again, of course, we know that it also depends on the quality of each of those three components, right? I mean, we can't generalize and say just because Quantica does it this way and they get that result, that is the same for everyone else. Well, what I can say is that, you know, at our firm, we started 10 years ago to do this, for example, dynamic portfolio risk allocation, meaning the risk budget could change every day depending on some factors, right? Otherwise, all things being equal, it's the same, right? And what I can say is that overall, the performance on an annualized basis is the same, but we've had a 25% reduction in our volatility. So would you say that's a good thing? I think investors would
absolutely.
say that's a good thing.
I'm saying it is a good thing, but I'm saying, is it because you've been tempted to that regime?
No, but it goes to the point where you say, oh, but if you start doing that, you're going to have more transaction cost, and that's going to cost you. And all I'm just saying is, no, that doesn't have to cost you. Just because you have more frequent trading doesn't mean you're going to make less money per se. If you can find other improvements as part of that, you can overcome that, right? So my point is just that I always get a little bit worried if we are too black and white. And I know some of us likes to be black and white because it makes the debate a little bit more juicy and interesting, and that's fine. I'm just saying I think it's a little bit more gray than black and white, because I do think, and this is why when Meb says, I just want the benchmark, I don't want the benchmark. I want to outperform the benchmark. I think most of my clients would want to outperform because otherwise they would just buy an index, but they still want the better manager. So I think that's and I think it's possible to outperform the benchmark over time for the really good managers, right? So, but I'm just saying there are more ways to skin a cat, and I think that's just what I'm trying to put as an example with some hard data, because I can see the data, and I think those improvements are real improvements.
I don't disagree, Neil. So, look, there is 1,000 ways to skin a dead cat, but I'm skinning my dead cat in my 100% investment in my trend signal. So I do use a lot of secret sauce in there. And no, I see where you're coming from, but you know,
but sorry to interrupt you here. Now it's getting really interesting here. But then again, you could say, well, hang on, you change your systems every single year, so you have to exit old systems and get into new systems. Well, that's also new extra transaction costs, right? But it doesn't mean that it's a
No,
bad
it's
thing to
not.
do.
No, so the way I do
I
that,
know that. Yeah, you
I
leave
let them
you let
play
the
out.
signal
I let
run.
them
Yeah,
play out.
I know. But still, all I'm just saying is you tweak the method as well in certain ways, and it works for you. And all I'm just saying is, I think there are many shades of gray, so to speak, as long as, and that's what we always come back to, as long as you keep the core principles of trend following alive. That's the key thing.
I would just say, though, that as we said last Saturday, everyone has a different line. And like sometimes, like my line is different than yours. So if people cross a certain line of what I define as core principles, um, then in your line is different. So there's really no, we're not always going to agree with what those core principles are. Like in a previous TTU, you didn't like the relative strength trend following. It's predictive or whatever. So that's your line, and so my line would be, more along, obviously with the vol management. So we all have these different definitions of what the core is. And then this was a good question that we had, or debate between Niels and me and Rich and maybe more Ritz, and we were debating this on email a few weeks ago, and then Niels and I did not get around to a lot of these ideas, and this is it's similar to the same thing we always talk about, but we're hitting on kind of different ways, so it's definitely worth picking up again, and then because I don't think I have enough time now to go through all this, but there's just two things I would want to say that. Your point about the short-term trading versus vol management. It's just all goes back to the short-term trading is fine. It's way different. It may get you out, but the system's been back tested. It has a sample size, and it's good or bad. And so that is way more robust than you can't even compare a shorter term system that doesn't participate in the full trend with the idea that vol management traders, they don't participate in the full trend either. I mean, it's way two different things. And as you know, I'm always going to come back to, it's all about the sample size. And then one of
Jerry,
the things I said, let me just finish. One of the things I
Okay.
said in that email was that not that these traders don't have the sample size. If you go back, I did not say they don't have it. I mean, maybe they don't. I don't think they do. But I didn't say that. My argument needs to be better than that. And I think it was. And it was that it's hard to count it. And that's, I think, a big problem with some of the vol management situations is not they don't have a million trades. And as you said, they have more trades than I have. It's just that how do you count those? Which buckets do you put them in? And that's just something you have to do. You just can't go back and say, if you have a million parameters, you're going to have, 800,000 trades. But, of course, the number of parameters is helps you define actually the sample size, and you can't count every trade because the different trades are done by different signals.
Yeah, no, I mean, I agree with your point that, of course, there is a sample size for those who use volatility adjustments or dynamic position sizing. And of course, I also agree with you that it can be harder to count, if you want to put it like that. Not impossible, I think. But of course, you could just run the same system with and without, and that would tell you the difference. But yeah, and of course, you're absolutely right. We all have different ways of doing it. But I think we all, and this is why I sometimes say that it's all about voicing our differences on the one subject that brings us together. And I think this is exactly what we're doing here and what we're doing every week.
And look, what I'd say is that I think the difference in approach is based on the opinion that one has over the validity of a back test. Really, that's where it comes down to. Does history, play have a role to play in determining your system, or Or do we loosen up that philosophy to say the future is totally uncertain, and whatever the backtest gives you, that's going to be, a curve fit response to that history? Should we be using that history to overtly sort of prescribe how our system should operate?
Yes, that's the cornerstone of what we do, is that we do know. How can you know? Well, we know because of the backtest. And then now for non-trend followers and systematic traders, that's laughable. You don't know. These backtests don't do anything for you. Okay, yes, we see where you're coming from, but we have a history of respecting these backtests, and that's why we spend so much time talking about how was it done? What is the sample size? Was it good? And so we do know what we're going to rely upon, and we do know what the rules are. And one of the rules we try to stick by is we're going to rely upon backtests that were done properly. And I think that's where a lot of the disagreement comes up, essentially, is that, and I've said this a million times, and that is that I'm probably too conservative and too restrictive on the backtest. And I probably will one of these days figure out that I could have been a bit more free and not so doctrinaire on these backtests. So, but it's everyone has their own way of looking at it. Like if someone came to probably any of us and said, look, I really don't think there's any reason to add currencies, commodities, and bonds, just stocks, just long only, we would say, no, that's crazy. You're getting at the core of what we do. You're way over the line here. And no. And so that's fine, but it's I'm just trying to say is that it's all situationally specific to what we can agree with and what we're going to do. And sometimes we can all agree that some ideas we would reject. And all I'm saying is that, and this is how I ended the last TTU, which was that, yes, if I have no trouble saying it's over the line if you're going at the heart of trend following, which is letting profits run. And too bad. Although I will leave open the possibility that if you get out of a trade and as it's approaching zero, a short that's approaching zero, or a long that's 500 or 1,000, or I think the first Bitcoin trade was, I don't know, thousands of ATRs. Okay, if you get out of some of those on the way up, or volatility increases in a random discretionary way, I think that's probably okay, right? So I think you cannot talk about some of these situations without being very specific about, what exactly are you talking about violating, and some of the things that people violate, I'm like, okay, cool. Diversification and letting profits run and taking small losses are three things that, yeah, that's over my line.
That's exactly right. We've all got our different models. And if someone crosses the line and tells us that an aspect of our model is not the way to do it, we will say, no, in my world, in my context, in my universe, in my model, this is the rules that I've generated for that model based on my validity over a huge sample size. These are the rules that stick. And really, what Niels is saying is very interesting, because but previously I talked about the TTU trend following index. Now, what this is saying is that if we could invest with an equal allocation into all trend following funds that have a greater than 15-year track record, the first thing that's saying is it's the track record that matters. It's not the performance statistic. It's not the Sharpe ratio. It's not the Sortino ratio. It's not even the Serenity ratio. It's a track record that is the best indicator of long-term performance, a validated long-term track record. And if we could invest in all of the 60 trend following funds who all have their different models, so they've all got their different viewpoints, we would produce the best returns out of all of those individual models. In other words, we produce a compound annual growth rate of 8.77% with a measly drawdown of 18% over a 22-year track record. Now, that is amazing. And that tells me that, yes, there are lots of different models operating with different philosophical viewpoints in the trend following space. But the key thing is they must have this validated track record as a testament to being able to survive over many different possible forms of regime. And the more we rely on statistical measures such as Sharp and all of these things, the more we get away from this validity of the long-term track record. And we start using these risk proxies that are only proxies. They're not the ultimate form of risk management. The best risk management tool we've got is a validated track record.
And you know what that does, Rich? It validates your point about system diversification, because those 59 managers, they all do things slightly differently.
I have to agree.
That's right, as long as it's slightly. It has to be slightly. Because, and then another thing that happens, and isn't it funny that I just can't, this is such a breakthrough that no ratio was as good as just investing in all of them. That's pretty fun. That's pretty good. That's pretty fun. So, and I think, people do enough, and the markets can be good enough, they can be trendy enough, and these outliers can be just monstrous that any sort of weakness that each of us has, kind of gets covered up. And so there's nothing more important than just diversifying, going with the trend, and playing for the outliers and trying not to do too much to screw that up. But anyways, this has been fascinating, and I need to go off and do something else today. But so not another 3 hours today. Maybe we can do 3 hours every now and then. But it's so much fun having Niels on, and thanks for because I know the TTU for me, the 1.5 hours is definitely not enough per week to talk about trend following or listen in on those guys each week. But anyways, thanks everybody for being here, and see you next week, same time.
Take care, everyone. Have a great weekend.
See you, everyone. Okay, bye.
Thank you.
Thanks, everyone. Bye-bye.